If you watched last Thursday's episode, I did actually make a promise that we would take a look at a company that are going to fight for top spot. Today is that day. Hey there guys, welcome to the FTSE Show, episode number 31. My name is Chris Chillingworth. Thank you very much for tuning in and checking us out. If you've never watched the show before, we are breaking down UK FTSE stocks, crossing the FTSE 100, the 250, the small cap, the fledgling and the AIM markets. And as me and my team of people are slowly churning our way through these companies, I'm bringing to you some very brief analysis of these companies. Now, when I say that because in Thursday's episode, I think it was Thursday's episode, somebody made a comment that, listen, your analysis isn't detailed enough. You're only doing 15 minutes of looking through this company. And I had to explain to this gentleman, I believe it was a gentleman, that this isn't all the analysis that we do on these companies. In fact, just to give you some insight into the work that goes into these companies, I have a team of people who help me do all the data entry and get all the information and the financials from the annual reports into a spreadsheet. I use that information to then run my analysis on those companies, financial analysis. Once we've looked at that financial analysis, only a certain percentage of companies make the grade, and at present over 250 companies that I've so far looked at, only 8% have ticked all the boxes and made the grade and are companies that I would want to invest in. From there, however, we still don't invest, because then we go through what I call the kind of the business analysis. So we're looking at, what does the company do? Let's read every single annual report we can get our hands on, and often that takes about 10 hours of reading time. It takes me about an hour to go through an annual report. So I've got 10 years worth of annual reports. That's 10 hours of my time going through those companies, and I'm looking for the focus of the company. What's the company working on? What's coming up in the future? What's the product or service that the company are making? What's the future hold for that kind of business? And I'm looking at all this different stuff. I'm looking at where the company feels like it's going, what the plans are for the business. Are they bringing out new products in the future? All of that kind of stuff. If I still like the company at that point, so they passed all the financial analysis, they look great on the annual reports and the business analysis, then we look at price. Does the price make sense of this company? Because often or not, we find these companies and they look fantastic, but they're currently trading at a price that just doesn't make sense in relation to the underlying value of the business. You know, there's stocks out there that are priced far too high for what they should be, and there are also every now and again companies out there that are trading at bargain prices. There are companies out there where we can buy a share for £1 and get £2 worth of assets from them. You know, so there are great opportunities out there as well. And at present time, without wanting to give too much away and devalue the membership that I run and the people that are on there and the service that they're getting, we've got right now, at time of publishing this video, about 6 companies that have passed all 3 of those stages and still look good from a price and analysis point of view. So we're talking about 6 companies out of 250 companies out there. We are very specialist in what we're looking for, and it serves us well. So we go through a lot of these companies and we do a lot of analysis. What you see in these videos, therefore, is 15 minutes of cramming as much in as we can. So when people turn around and say, you've only done 15 minutes of analysis, you need to do a lot more, I'm like, no, listen, I can't cram it all into a 15-minute video. I'm just giving you a brief insight into the work that goes into this, basically, and giving you hopefully adding some value somewhat to those that are interested in trying to help work out, how do I find out what the right stocks are, essentially. Today we're going to take a look at a company that I think are going to fight for top spot. They're a company called Autotrader PLC, and they are the very well-known car sales website used by people who want to sell the vehicles, as well as tradesmen and private sellers, and obviously the end users, the people who want to buy the vehicles. And it's just a middleman, essentially, website. Much like Airbnb don't own any hotels, much like Uber don't own any taxis, or Autotrader don't own any cars. They're just the in-between, and they make a ton of money doing that. So the numbers are going to be very exciting. They're going to look very good, to give you some pre-warning. In terms of So I'll talk about pricing at the end of this, towards the end of this episode, before we chuck them up on the leaderboard. But let's not delay any further. Let's dive into those numbers. Okay, so we're taking a look at Autotrader Group PLC. Epic code is AUTO. They're in the FTSE 100 in the retailer sector. So we've got 6 years worth of history here to look at since they floated on the exchange. And revenue-wise, we can see that has gone up year after year. Real consistent growth here. And whilst they're not, huge company like some of the other companies we've looked at, this is really promising. This is consistent year-on-year growth in revenue. So what it tells us is that Autotrader are finding ways to get out there and make more money, whether that's by raising prices, finding more customers, whatever it might be. But they're doing a good job there, and they've been able to bring in more revenue every single year. And as of 2019's report, we're looking at 355 million in revenue coming in. The expenses of the company are very, very solid, in so much that they're quite low. And you can imagine this with Autotrader. They're a website company, not many overheads as such. They're kind of when we look at some of these companies and the growing trend of companies that act as kind of the middleman between somebody who wants to sell their vehicle and providing a platform like YouTube, who don't produce any videos such themselves. They just provide the platform for people to put their stuff on the website. Like Uber, who don't own any taxis as such, Airbnb, that don't own any hotels. Well, Autotrader, they don't own any cars. They just provide the platform for both sides of that business to use. So sellers can put their cars up and buyers can go there to buy cars, and they just act as that middleman, and they make a huge amount of money out of doing that. And as a result of that, their expenses can be very low. And as we can see here, what I like about this is not only are the expenses low, but there's a downward trend. So in 2014, 2015, we're looking at 58% of the gross profit being spent on expenses. But as you can see, we're talking about 130 million, 122 million. We're now down to 112 million, where it's sat consistently now roughly for the last 4 years. And because revenue's been going up and expenses have stayed flat at the same point every year for the last 4 years, the percentage of those expenses taken out of the gross profit is reducing, and it's falling. Which is fantastic. They're already at great levels, but the fact that there's a downward trend here where the expenses are managing to stay exactly the same level whilst revenues grow, it's even better. We've got no worries about depreciation or R&D, and interest on debt really isn't high, and hasn't been high now for a good number of years. We often find with an IPO, when a company's first float on the exchange, that they often have to borrow some money to make that happen, because there are a lot of costs involved in floating, and so this is fine. The expenses were quite high, or sorry, the interest on debt was quite high when they first appeared on the exchange, but they've totally got that under control now, and we're looking at very happy figures there. And when we come down to the actual net earnings, this is glorious. 45%, 49.7%, 51.8%, now up to 53%. So every year we've seen growth. Again, first 2 years, not really making much of a profit there. Not really a company we'd be jumping up and down and getting excited about at that point. But then from 2016 onwards, Autotrader's numbers have been fantastic. There's 45% profit on the revenue that's coming in after all deductions. Still keeping 45% of that revenue is a very efficient business, and that's a big margin. And that's climbed from 45 to 49 to 51 to 53 now in 2019. So income statement wise, Autotrader looking absolutely fantastic. Over 50% net earnings a year. They're keeping over half of the slice of the pie after all deductions. That's fantastic. That's after tax and everything. So very impressive numbers there. Coming down to the balance sheet, and we can see that liabilities, the short-term liabilities, just about overshadow the assets. We're looking at short-term liabilities being 66 million, short-term assets only being 62 million, so not quite covering them, but not a big deal, not a big, there's not something that's going to really scare me off. What is something that we would have to bear in mind is that the majority of their assets come from intangible assets, so it's rights, licenses, that sort of thing. So it's the Autotrader name essentially and the website probably, which aren't, they're not assets you can hold in your hands, hence why they're intangible. And Autotrader don't really have a great deal of assets, 450 million worth of assets, and then obviously we've got liabilities, we've got accounts payable, we've got current tax liabilities, stuff like that, and then there is debt here with Autotrader. Now, again, like I said, when they first came on the scene on the London Stock Exchange, which was only 2014, they came in with 1.1 billion worth of long-term debt outstanding. I love the fact that that has been drawn all the way down now to 310 million in outstanding debt. That's well within the levels that they should be borrowing in terms of how much they can pay off, their earnings power relative to their earnings power. That's a very healthy figure. That I love the fact that it has been going down every single year. So every single year it's just taken a big chunk off that debt, which is fantastic. Right now, based on the fact that they're making 188 million a year in profit, they're only borrowing 310 million, so it's going to take them a year and a half to pay off that debt if they needed to. So well within the region of what we would be looking for. But the shareholder equity is very low. And that is essentially the assets that the company owns, which really isn't that much, because they're just a website. They don't have a fleet of vehicles. They don't have much property or much plant or much equipment. So there's not a huge amount of assets in this business. So what you're essentially buying when you're buying Autotrader is you're buying their website and the intangible assets, what the intangibles are worth. Some investors aren't keen on that. Others couldn't give a monkeys. So it depends what kind of investor you are really, and how much stock you put in having tangible assets within that business. But the shareholder equity is only at 59 million, and it's only recently reached positive equity, where the liabilities were overshadowing or outweighing the assets. That's now not the case. Assets are now outweighing liabilities, and obviously the reduction of that debt is really helping. But it's still very low. It's only 59 million in shareholder equity. So in terms of retained earnings, fantastic. Look at these. They're sitting on essentially nearly 1.1 billion in retained earnings, and again, every year pumping more money into the retained earnings. So a fair amount of profit of that profit that they're making every year is being pumped into here. They're also buying back their own shares, which is great. That's reducing the amount that are outstanding. That's putting more value on the ones that are still outstanding. Still available, so that's great because that can help drive share prices upwards as well. And obviously the return on shareholder equity scores, they're kind of all over the place because the shareholder equity is very low, the return is very decent, and as a result of that the percentage levels are very, very high for a company like this. And they don't really spend much on capital expenditure, as we would expect. They're not having to buy a load of vehicles to deliver anything. It is just a website service, but a website service that is making a hell of a lot of money. And let's go over and take a look at how their chart has been doing for the share price. Okay, so here's a company that's been doing very well over the last 5 years. Since they floated on the exchange, they came in at a price of, it looks like about £2.60 a share. Now currently sitting at £5 a share. It's definitely been a stock that's on its way up, and that would make sense because the numbers are looking very strong. There's a good trend there in the right direction. In terms of the 2020 crash, they aren't a million miles away from fully recovering, are they? And we've seen this with a couple of companies. But I believe Autotrader have done particularly well, and some of the news that's come out of the company is that there's been quite a strong buy-up in people in lockdown buying vehicles. So where people have been found themselves stranded, who have been relying on public transport, well, they've not been able to use public transport. Even the government, even today, are still saying, please try not to use public transport. And so people are relying on cars more right now to get about. And Autotrader has seen a positive impact on their sales and the commissions that they're making on people buying cars through their website. And when we look at Autotrader, they are really the known name for if you want to buy a car online. It's the place to go, and they've got a pretty strong brand there. So they've been doing very well as an investment over the last 5 years. And looking at those numbers that we've just looked at, they're looking very strong. A very, very strong company, making significant margin, making significant profits on the revenue that's coming in. Probably not going to be too adversely affected in comparison to other companies over the 2020 crisis, if you will. But yeah, overall, these guys score very nicely. Let's go and take a look and see how they fared on the leaderboard. Okay, so really awesome numbers, and this is a company that are doing very, very well. They've been around for a long, long time, but they only floated in 2014 or so. So only recently, in the grand scheme of things, been part of the exchange and been a company that the public can invest in. But still going strong, still growing in revenue, still moving forward. And I really like the company. I really like the business. I did say I was going to talk about pricing before we chuck them up on the leaderboard. Listen, I think right now, for me, I can only talk about me and my approach to this, but I think the Autotrader price right now is a little bit too high. It's currently trading about £5 a share. For that, the earnings per share is about 21 pence. So for every £5 share you're getting 21 pence of earnings. It works about 4%. It's quite low. It's not a great return. Listen, the way I like to work things out is if you were to buy all the outstanding shares in the company for today's price, then you could buy this company for X amount of money. What's the percentage of earnings you would be getting if you owned all the shares, essentially? And at present it's about 4%, so it's not very good. The earnings per share is quite low, and therefore I'd want to see a lower entry price, and therefore I'd probably be looking at about £2, £2.50 would be my ideal price to get in. That'd be the sweet spot, the perfect price. It's trading at £5 a share at the moment, so that's a bit high for me. If it went down, maybe I'd get in, maybe I'd be quite keen. But also looking at the assets that you will get for the shares that you buy. If you're buying a share for £5 a share, you're getting 6 pence on assets per share, which is really low. So, I mean, they don't have a lot of assets to talk about, so that's why that is so low. But again, it would suggest that you're paying £5 for not very much. And so for me as a long-term investor, when we're looking at the price against the underlying value and the intrinsic value of the business, the price is a little bit high for Autotrader. Something to bear in mind. That doesn't mean that you can't get in at £5 and do very well over the next 10 years with this company if they continue to smash the numbers like they have been. It just means for me, I'd want a cheaper price if I could get it. In terms of news that's come out of the business or the company have cut the board's pay, so that's a good sign. The board are willing to take a pay cut in these testing times. They've been extending free advertising or delayed costs. They've been delaying the terms for advertisers to have to pay their bills with them. This is a company that are doing very well financially, and they've got good retained earnings. They've got relatively low debt. They've got great profit margins as well, so they can afford to do these things, and it's great to see them doing this sort of stuff. And they have recently announced that they expect their full-year profits to really kind of fall in line with what the market expected. So they're not expecting to have too much of a hit, which is a great sign as well. But let's get them up on the board. Most things here very positive. The only downside with Autotrader, I think, is the price is a bit high. Like I say, you could still do very well at £5 a share today and see that go up. Who knows is the answer there. It's very, very difficult to know where share prices are going to go because they're not logical. But the underlying value of the business is a lot lower. Very high score otherwise, very high score. And I think we have a new champion at the top of the board. Autotrader score a very impressive 133 points. So let's get them up. Okay, so very happy to have a new company at the top of the leaderboard. Autotrader Pip Taylor Wimpey for that top spot, which is awesome. They've knocked Dixon's off. Remember, if you saw one of the previous episodes, I said I'm not going to add any more to this board now. We're going to stick at 30 companies. Dixon's relegated. So, shucks. But I think in the grand scheme of things, listen, when we're looking for companies to invest in, when there's a company that's making over 50% net earnings a year, you know that there's a good chance they're going to do very well in the future. Share price with Autotrader has gone up something like from about £2.60 to £5 a share in the last 4 or 5 years. That's pretty decent growth in share price. Obviously, they've taken a hit in 2020, but if they continue to do what they've been doing over the last 4 years, over the next 10 years, then I think we can expect to see a growth in share price. So, yeah, I really like the numbers. I really like the company. I really like what they do. I think there's definitely a future out there for this for the Autotrader website. The brand is strong. There isn't a huge amount of competition out there that's vying for that name, for that position. You'd need quite a significant disruptor to come along and somehow do something different to improve upon what Autotrader are doing to really knock their brand back. Thank you very much for watching, guys. I hope you find this episode has been of value, and I hope you'll catch us on Thursday's episode later in the week. Cheers.